Hey everybody, so in this video I wanted to talk about Signature Bank. Now this is another one of those banks that got caught up in that whole Silvergate bank contagion. So as we can see here, this stock fell over 30%. So it was around like $113. Now it's around $70. So yeah, that's over 30%. Now you can see at the high, this was trading around $374. So this was trading quite high around early 2022. Now, let's just go ahead and read a little bit about this company. So instead of just reading your typical report done by somebody else, I'd rather just go into the Form 10K and kind of do my own research here. So I kind of found on page 8 just the nature of their digital asset business. So if we're just looking right here, you can see a digital asset banking business. So here they kind of define the scope of this business. So it says right here, the bank does not lend to the cryptocurrency industry. So that's a good sign. They're not lending to the cryptocurrency industry. Nor do we have any loans backed by a cryptocurrency. Another good sign. The bank does not invest, hold, or custody cryptocurrency assets. So this is not like a Coinbase. This is just your regular old bank. Now, instead, the bank's relationship with clients in the digital asset ecosystem are limited to the United States dollar denominated deposits, which can be transferred to other clients on a real-time basis on the Signet platform. So basically, they're saying, hey, you know what? Our relationship with these clients is that we basically hold their money. So that's basically what they're saying. And it says, additionally, the bank does not onboard stablecoin users with algorithmic backing or those that do not hold a one-to-one reserve of United States dollars or United States equivalents to coin outstanding. Now, what does this mean, one-to-one reserve? Now, we heard this quite a bit with FTX. So the situation with FTX, basically, they were using their clients' funds. So if I deposited $100,000 into my brokerage account or whatever, they were pretty much using that money, but they didn't have the availability to give that back to me if I requested it. So therefore, it's not one-to-one. So one-to-one means that, hey, if I deposit money with you, that money, it's going to show up on your liabilities. So if I deposit $100,000 with Signature Bank, then on their liabilities, they're going to have deposits for $100,000. Because when I ask for that back, they are liable to give it back to me. It's an obligation that they have to me as a customer. So that's what one-to-one means. So right here, this is the concerning part right here. So the concerning part is as of December 31st, 2022, the bank's digital assets deposits totaled $17.79 billion or 20% of total deposits. Now that right there is a little bit worrisome because this is an industry that is not very stable right now. We're seeing Bitcoin basically crumble. I call it Bitcrumbs because it's crumbling. But as you can tell, the cryptocurrency industry is not doing too well. Now, this bank has 20% of their deposits with these digital asset companies. So that's kind of like the risk that they have here. They have too much of their deposits in this area. Now, let's go ahead and jump over to their balance sheet. So if I'm looking at their balance sheet, let's see. I'm going to move this over. I'm going to show you that later. Their balance sheet is on page 121. So I had that written down there. So here is their balance sheet. Now, let me show you what I'm talking about. So if we're looking at the liabilities and shareholders' equity, hey, you know what? Deposits. So if we're looking at total deposits, $88.58 billion. Let's go back to page 8. So $88.5 billion is their deposits. Now here, 17.79 billion of that 88 billion is basically from these digital asset companies. So let's go back to that balance sheet right there. So that's basically what we're looking at right there. So as you guys can see, when a customer deposits money with you, that goes in the liability section. So let's also look at something else. So here we have securities available for sale and securities held to maturity. So these are basically their investments here. So this will kind of give you an idea of some risk, because you guys remember that last video that I made. I was talking about some of the risk that we saw with their available for sale assets. So we could go ahead and jump right into that. So you can find that on page 141. Alrighty, so right here we can see a list of different assets. Now let me remind you again what available for sale is. So available for sale is basically a classification of assets. So if you say we have assets available for sale, that means that you purchase the assets with the intention of trading it before it matures. So these are usually debt securities. So that is what available for sale means. Held to maturity is exactly what it means. You're holding it until that debt security matures. So available for sale, this is current assets. Held to maturity, that is long-term assets. So right here, we can see U.S. Treasuries, we can see the amortized cost, and we can see the fair value. So if you're just looking at the amortized cost and the fair value, the difference between that is going to be the unrealized loss or gain. So this is basically a paper loss right there. So if we're assuming that they are going to sell these, then if they sold it now, then yeah, they'd be taking a pretty hefty loss, because right here, these numbers aren't thousands. So this right here is $4.6 million on U.S. Treasuries. That's a loss. And keep in mind, this is because interest rates are going up and they didn't get a favorable interest rate. So therefore, the fair value is not worth as much. And right here, you can see residential mortgage-backed securities. You have U.S. government agencies and government-sponsored enterprises, so like your Freddie Macs and your Fannie Mae's, so things like that. So right here, they're taking a pretty big loss. That's $838 million. Right here, that's another big loss. That's $1.147 billion. That's a collateralized mortgage obligations, CMOs. This is basically, you're packaging up all of these mortgages, and then they're selling it, and then there's different risk levels to these mortgages, so they sell them in different tranches, and based on those tranches you get a certain amount of interest. So that's what's going on with this. So yeah, obviously they're taking a hell of a loss here, so pretty big paper loss. Now if we're looking at total available for sale, you're looking at their amortized cost versus their fair value. Well, they're taking about a $2.48 billion hit, so not a good sign right there. Now, also we could scroll down a little bit. We could look at their held to maturity. They're also taking a little bit of a loss right there too. So $765 million. Now let's jump back to the balance sheet, and we go to page 121. Now, honestly, bank stocks are a little bit hard to value, which is why I'm not as confident in investing in these type of stocks, just because it's really complicated. There's a lot of complicated things going on. And if we're just talking about loans, it's a little bit difficult to understand how safe the loans that they're giving out exactly are. Because, obviously, you guys remember 2008. So that's always my fear, investing in a bank company and then having something like Silicon Valley Bank happening. Like, oh my gosh, what a stressor if you were investing in that company. Now, what I like to look at is total shareholders' equity. So we can see that this value actually increased. But you do have to always keep in mind that when you're looking at total shareholders' equity, you're also looking at shares outstanding. So right here, I do have this nice little spreadsheet. So let's see, it's right here, which I'm going to move over. Alrighty. So right here, I have these numbers are in thousands except per share data. So I got the shareholders equity for several years. So basically what we're doing is we're doing horizontal analysis, which is looking over time. And we're also doing vertical analysis as well, because we're looking at the actual individual items within the same year, and we're comparing it as a ratio. So that's vertical analysis. So if we're getting shareholders equity and we divide it by shares outstanding, that's going to give us book value per share. And if we go back to 2013, we can see that book value per share has been increasing. So here, increasing, 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 increasing. Oop, halt. So right here, we see in 2022, that number went down. Now, a lot of that has to do with that loss from those paper losses that we saw in the available for sale asset category. So right here, we can see that book value per share is 127.99. Now, you know, if we're looking over at 2022, so if we're just looking right around this period, which is kind of when they reported, you know, the stock price is right around like, I would say that's like 116 or something. So if I go back, and I actually put 116 right here, then we could calculate something called price to book. Essentially, price to book is what I'm doing is I'm pretty much getting the stock price right around the earnings report for the full year, and then I am dividing that number by book value per share. And then this is going to give me some sort of ratio, and I could compare that over time, or I could compare it to different different companies in the same industry. So we can see right here over time, this was around 2.7, 2.2, 2.2, 2, but then all of a sudden in 2017 through 2020, you know, this was going sub 2. Price to book was going like 1.89, 1.52, 1.48, and then 1.27. And then here in 2021, like, wow, this went all the way to $2 or 2.37. But here in 2022, 0.91. Now, if we input the current price right now, yeah, price to book is very, very cheap. This is literally trading way under book value. So this makes me wonder, like, hey, is this just really cheap and people are overselling it? Or is there something going on? Like, is there some serious shit underneath the trunk? And if you guys heard about Silicon Valley Bank, they pretty much closed. They closed, and the FDIC came in. They took over all the assets, and now they're basically opening up withdrawals on Monday, I believe. So that's a very, very scary situation. And this was a really big bank. I mean, I remember reading that this was like the 16th biggest one. So yeah, I mean, stressful, right? So, you know, make sure that when you have money in a bank, it's a bank that is FDIC insured. So I believe that covers up to like $250,000. Now, if you have more than that, then you know what? Pull a Palantir and just freaking buy some gold bars or something. Make a freaking mattress out of gold bars, or do something, you know, make a pillow out of gold bars, make like basically make like a leg rise made out of gold bars or something. I don't know. Do something. Basically, shit could go down here. There is some distress in the financial sector. So I hope you guys enjoyed this video and have a good one.